A market crash happens when there's a sharp and sudden drop in the prices of securities, stocks, bonds, or other assets. This typically stems from a mix of factors like economic downturns, geopolitical instability, rising interest rates, or investor panic. Here's a closer look at what happens during a crash and how to prepare. What happens in a market crash? 1. Rapid loss of value. Prices fall quickly as investors rush to sell. The drop can be so severe that it erodes a large percentage of the market's value within days or weeks. 2. Investor panic. Fear of further losses often fuels panic selling. When many people sell at once, prices drop further, intensifying the crash. 3. Credit freezes. Banks and lenders become cautious and credit can tighten. This makes borrowing more difficult for companies, which can lead to layoffs, reduced spending, and even bankruptcies. 4. Reduced economic confidence. With falling investment values, individuals and businesses may cut spending. This drop in demand can lead to a recession where economic growth stalls or reverses. 5. Government and central bank intervention. Governments or central banks may step in to stabilize the market by lowering interest rates, buying assets, or introducing stimulus packages. How to prepare for a market crash? 1. Build an emergency fund. A cash cushion can help cover expenses if your investments lose value or if income decreases in an economic downturn. Aim for 3 to 6 months of expenses in an easily accessible account. 2. Diversify investments. Holding a mix of stocks, bonds, and other assets reduces risk. Different assets react differently to market conditions, so diversifying can help protect against losses. 3. Invest in defensive assets. During market crashes, defensive sectors like utilities, healthcare, or consumer staples and safer assets like high-grade bonds tend to perform better. 4. Stick to a long-term plan. The stock market has historically recovered from crashes. If you have a well-thought-out, long-term investment strategy, staying invested may be more beneficial than selling in a panic. 5. Avoid high-risk, high-volatility assets. Assets like speculative stocks, certain cryptocurrencies, or highly leveraged investments can amplify losses during a crash. 6. Consider dollar-cost averaging DCA. Investing a fixed amount regularly DCA can reduce the impact of market volatility on your portfolio since you'll be buying more shares when prices are low and fewer when prices are high. 7. Review your risk tolerance. Your tolerance for risk may change over time, especially if a market crash would affect your retirement or other goals. Adjust your portfolio if necessary to align with your current comfort level. Preparing for a market crash is about building a resilient financial strategy that can weather economic downturns, so that when the crash passes, as they historically do, you're still in a strong position. Please remember to subscribe to the channel.